Okay, I move to an area called credit derivatives. Technically, valuation of credit derivative is not there in your syllabus. At CFA, in CFA, which is the for the finance, one of the reputed courses, there this is discussed extensively. The credit derivative part is discussed extensively. For our discussion purpose, limited basic terms we will try to understand, and some basic questions we will do. Again, ICISM does not have any question on credit derivatives also. The newer areas, whatever they introduced startup valuation, all that they did not give any question. So credit derivatives, they introduced it in your syllabus, but they did not give any problems on this. Let's understand this first. Now, this is the situation. Company A is raising funds by issuing not shares, it should be issuing bonds. By issuing bonds, which is an underlying company, it is issuing bonds. Bank B, and there are investor. There are three people in this, okay? There is a company A, there is an investor, and there is a bank B. Now, what is the role here? Company A, I am Reliance Industries Limited. I am issuing bonds. You invested in my bonds. But you are worried about only one factor, whether I will default on my obligation. I will default on my obligation, which is practical world a significant risk. There is a significant risk which is there, because in the practical world, companies may end up defaulting on their commitments. So what you do is you go to an insurance company and tell them that, can you give me insurance against this risk of default? Can you give me insurance against this risk of default? Now, what is the insurance going to do? You go to that insurance company, say them that I'll pay premium every year. Reliance pays me interest every year. My premium becomes sunk cost. You need not return it to me. I take a vehicle insurance. Anything happens to the vehicle, I get some money back. Nothing happens to the vehicle, that premium is an expense for us. Nothing can be done. So I pay a premium to a merchant banker or an investment banker or a normal bank, because these parties will become the insurance company now. So I go to bank B, pay them premium at the beginning of year 1. First year goes by, nothing happens. The Reliance Industries is paying my interest on time. This premium is a loss for me. Second year again I pay premium. Third year again I pay premium. Fourth year again I pay premium. Fifth year I pay premium. 5 years, Reliance Industries repaid my bonds, everything got over. 5-year premium is an expense for me. I was okay with that, because my logic was, I'm getting an interest income of 8%. Let me pay 0.5% or 1% premium, so that net we earn 7% without any major risk. This is the logic of a credit derivative. The logic of a credit derivative is, what happens here is, there is a company which is issuing bonds, which is issuing debentures, and we have seen practical world, companies can fail, and if companies fail, it is going to put us under a lot of trouble, and I don't want to be under that trouble. So I go to a bank, get this instrument done. Now, I'm not sure how many of you would have read about 2008 financial crisis which had happened. That crisis happened because of this instrument called as credit default swap. What happened there is, the banks, where our companies, banks were doing lot of money raising was happening. People were investing in it. So I am a bank. What I did is, I gave loan to you. I gave loan to lot of people. You are not a company or not a person who is having that strength to repay the loan. But what did I do? I kept on giving loan to lot of people. After giving the loan, I bought protection from another bank. Bank A gave loan to so many people, and I wanted protection. So I went to bank B, got protection. Like this, bank A was getting protection from bank B, bank C was getting protection from bank B, bank D was getting protection from bank B, and that bank was Lehman Brothers, which itself collapsed. The insurance company itself collapsed there. So you ended up giving protection, but in the end, whoever was giving protection itself got collapsed in the market. So underlying company defaulted. So in this example, company A defaulted. Bank B is also defaulting, because you got protection from bank B. So because of reckless, lot of lending happened, that crisis happened there. In India, RBI has lot of restriction, so nobody can randomly become a protection seller. I cannot say that you take a loan from or you give money to Reliance Industries Limited and take protection from me. You pay me a premium of 1%. I will take care in case a default happens. If you are interested, do read about role of CDS in that crisis which had happened, just for your understanding, because this instrument become one of the major reason for that financial crisis which happened that time, and it was a big crisis. Okay, that time stock market in India and all went down by 50%. Today, now when it has gone down by 15-20% itself, people are a lot worried. That time the stock market went down, some of the companies went down by 80-90% and all. Because of that crisis, the reason for that crisis is one of the major reasons is this instrument which you are talking about. The instrument is credit default swap. I'll repeat, what does the instrument do? I want to raise money. I am not a strong company. You want to invest money in my company because I give 15% rate of interest. So I give very high rate of interest. You are interested in my company, but also worried, because natural. Why are you worried about my company? Because I am not a credit strong company. That is why I am paying 15% interest. So somewhere you got greedy, wanted to earn 15%, but also wants to protect the risk. There will be an insurance company. Because I'm a risky company, he may charge 4-5% insurance. The premium can be on the higher side. The premium can be on the premium depends on how much is the risk of default. When I take a vehicle insurance, the premiums are different. When you take a car insurance, so when you take a two-wheeler, premium is different. Car premium is different. Health insurance, younger person premium are different. Older person premiums are different. It all depends on what is the risk of loss for the insurance company. For an older person, they keep a high premium because health issue can happen, and that's why they keep a high premium. Similarly, for Reliance Industries Limited loan, the premium could be very low. For the other Reliance, which is Anil Ambani's group company, the premiums can be on the higher side because that is not a financially strong company. So here, there's a company A which wants to raise money. There is an investor. You are the investor. You want protection. You want protection against what? Risk of default. You want protection against risk of default. To get this protection, what you want to do? You want to pay premium. You want to pay premium. What does bank B does? The bank B collects premium. It is a over the counter product. What is over the counter? Trading does not happen. OTC. OTC means you will go to the bank, tell your requirement, and bank will give you protection. Mostly it's an OTC product. I'm not sure if it's traded in India. I did not find any trading happening. In abroad, maybe somewhere trading can also happen. Now, why is this being entered? This is being entered because of this reason. Just give me a minute. The reason for entering is this: no default on debt, default on debt. No default on debt, ignore or forget the premium paid. Ignore or forget the premium which has been paid. If default happens, I can do two things. One is called cash settlement and there is a physical settlement. Simple logic of cash settlement and physical settlement. If it's a physical settlement, I will go and give those Reliance bonds to this bank. Say that I don't want these bonds. They have become useless now in the market. Market has crashed because it was 100 rupee bond. When suddenly default happened, 100 rupee bond has gone down to 20 rupees or 10 rupees. So I just pick these bonds and give it to the bank. He pays me 100 rupees. He pays me 100 rupees and I give this bonds to the bank. What is net settlement? 100 minus 20, 80 rupee my loss. He pays me 80 rupees. He pays the loss which has happened. So there is a physical settlement. There is also a net settlement. Physical settlement, I take the bonds, transfer it to bank B. Tell them these are useless bonds. You take them, give me 100 rupees. What bank B will do? They'll sell it at 20 rupees in the market. They'll end up selling it at 20 rupees in the market because price from 100 has gone down to 20. 100 can even go down to 0 also. 100 can even, or 1 rupee also technically. It can go down to any number. So I just give these bonds, tell them give me the money. What's the other option I have? 100 minus whatever is the price. Loss is this much. Please pay my loss. Please pay my loss. Default happens, there will be a settlement. No default happens, ignore or forget. Ignore or forget the premium. Clear? Any doubts on this? I'll keep involving new terms. So first term I want to involve is protection buyer and protection seller. Who's protection buyer? You all are protection buyer because you invested in Reliance Industries and you wanted protection. Who's protection seller? Technically, I am the protection seller. I am the bank B. I am the bank B. Which is the company? Companies, let's assume Bharadwaj Institute. First month, Bharadwaj Institute paid you interest. You are happy. I am also happy. Bharadwaj Institute is also happy. Nobody is defaulting. No problem. Second month, they pay you interest. You also don't say anything. I also don't tell you anything. Third month, they default. Moment default happens, you will come back to me saying that take these bonds, pay me the money. You do whatever you want to do with Bharadwaj Institute. That's your headache. You please pay me the money of the bonds. I don't, because I paid you this premium. Your job is to pay me this money. I'll say, do you want me to do physical settlement? You say yes, give the bonds, I pay the money to you. Then you say, no, I don't want physical settlement and all. Can you please do a net settlement? I will keep the bonds. I want to keep the bond. You just do a net settlement. I'll find out what is your loss, pay you the loss. How is the premium calculated? Premium is equal to notional amount. What is notional amount? Is on what amount? On what amount you want protection? You want protection of 5 crore, pay 5 crore into 2%. CDS spread is called premium. The term CDS spread. CDS is credit default swap. Credit default swap. So the CDS spread is called as the premium which needs to be paid. So if I tell you to pay 2% premium, 2% into 5 crore every year. 2% into 50 crores every year, 2% into 50 lakh every year, 2% into 5 lakh. In abroad, even without taking a loan, people may buy protection, even without taking a loan, because they are speculating. They are speculating that Reliance will default, and if it defaults, we will get huge money. We will get huge money. In India, without an underlying asset, that is without investing in Bharadwaj Institute, you cannot buy protection against Bharadwaj Institute default, because RBI has put lot of condition, lot of restriction, very well regulated market in India. In that crisis also, Indian market did not collapse because RBI, SEBI put lot of restrictions on the companies, and somewhere we were able to manage that crisis in a smoother manner. But otherwise, those companies, lot of NPA, lot of challenges happened there. So in India, because of this, so your CDS instrument, that is the credit default swap, lot of people, what they will do is, I feel Reliance will default. So what I do, I say, give me protection against 50 crore, I'll pay you 0.5%, because Reliance is a very strong company. I pay only 0.5%. Reliance is not defaulting, my premium loss will keep happening. Moment Reliance default, I may get 50 crore rupee. I may get 50 crore rupee, and I want to just speculate. It is just a speculation. So you can do speculation. In India's context, you can do only hedging. What is hedging? Is you invested in Bharadwaj Institute and you wanted protection. You wanted protection. Clear? Any doubts till this? Any doubts on this? So there is a underlying investor, there's an underlying company, and there is a protection seller. There's a protection seller. Bharadwaj Institute and I do not have any link in this transaction, because I can be a protection seller for anyone. I am not bothered whether it is Reliance Industries Limited or Reliance Infra or Tata Consultancy Services. My job is to give protection against default. I will analyze the balance sheet. I will feel whether there is a risk or not, and I will say premium 3%, 5%, 2%, 1%, 4%. If I feel risk is there, higher premium. Risk is not there, lower premium. Clear? Understood till this? Okay, example of a CDS transaction. I'll keep reading it. This is in question bank. You need not open it. Page, I'll just keep reading it. Let us consider a simple example of a credit default swap transaction involving three parties: company A, bank B, and an investor C. Company A, this is the underlying company, and the company A issues bonds to raise funds, and these bonds are traded in the market. It could be traded, it could not be traded, but let's assume they are traded in the market. Bank B, this is the financial institution. This is the financial institution that acts as the protection seller, in the CDS transaction. It assumes the risk of company A defaulting on its bond payment. I take that risk. If company A is defaulting, don't worry, I am there. Don't worry, I am there. If company A is defaulting is what I come and tell you. For example, I want to take a loan, and let's assume TCS gives this guarantee saying that If Dinesh Jain defaults on the loan, TCS will pay. People will be very happy to give a loan to me, because in the practical world, the reputation of TCS is very high. Somewhere you have a belief that TCS will not default on the obligation. So if a bank like ICICI Bank or an SBI Bank gives this guarantee saying that I give a guarantee Reliance Industries will not default, then all of us become very happy saying that there is a guarantee from ICICI Bank, and ICICI and all is a very big bank, it will not default. Only problem here is in US, that bigger bank which everyone were comfortable, that itself collapsed, that itself ended up collapsing. That is because there was a huge amount of CDS buying, selling, they did a lot of things, and because of which the problem happened. Investor C, this is the investor who wants to hedge against the risk of a company A defaulting. Investor C buys protection from bank B in the form of a CDS contract. What does the contract agreement says? Investor C approaches bank B. Investor C approaches bank B to enter into a CDS contract to hedge against the default risk. They agree on the terms. What are the terms? Notional amount. What is the notional amount? 50 lakh, 1 crore, 2 crore, 5 crore, 10 crore, 50 crore. Premium. What is a premium? How much CDS spread you want to pay? Maturity date. You want to for 1 year, 5 year, 10 year, 15 year, 20 year, 25 year. Normally, tenor of the loan is equal to the tenor of the agreement. Normally. Notional exposure. Hypothetical or reference amount on which the CDS contract is entered. In my example, let's assume it's 10 lakh. Let us assume you took a protection for 10 lakh. Premium. Investor C agrees to pay a periodic premium. What is periodic premium? You have to pay every year, every 6 months, every 3 months, every 1 month, depending on the terms of the agreement. Normal logic is interest paid every 6 months, premium paid every 6 months. Interest paid every 6 months, premium paid every 6 months. Why is this? I get one inflow, I pay a part of the money and balances my income. Balances my income. Normally, this will be the terms. If the CDS spread is 2%, you have to pay 20,000 annually. You have to pay 20,000 annually. Default event. If company A defaults on its bond payment during the terms of the CDS contract, bank B will be required to compensate investor C for the loss incurred. No default. If company A does not default during the terms of the CDS contract, investor C will continue to pay the agreed premium. Contract will expire at the maturity date without any payment for the default events. This is as far as your no default scenario is concerned. So there is a default scenario and there is a no default scenario. What kind of settlement can happen? Cash settlement or physical settlement. What is cash settlement? If a credit default occurs, the CDS contract is triggered. Bank B will pay investor C an amount equal to the notional amount minus the recovery. 10 lakh is the notional amount, but that bond can recover 2 lakh rupees. That bond can still give you 2 lakh rupees, because even after the default, certain times after the default also some money can come back. So what money can come back is 2 lakh, 3 lakh, 4 lakh, 5 lakh. That money I deduct and balance amount I pay you. Balance amount I pay you. For example, recovery here is 40%. If recovery is 40%, I will pay you 60% of 10 lakh. If recovery is 40%, I will pay you 60% of 10 lakh. Other scenario, what I can do? You give me the bonds. You give me the bonds. How much I'll pay you? 10 lakh. What will I do after paying? I will sell and recover 40%. I'll sell and recover 40%. My loss is 60%. Clear? Any doubts on this? Let's do some question. Let's come to 74. Company A has issued, question 74, page 290. Company A has issued 10% bonds of 50 lakh. Investor A has purchased bonds worth 10 lakh, but is worried about the risk of default. He therefore wants protection against the risk of default and hence has purchased protection from Axis Bank in terms of the CDS contract. Axis Bank, obviously reputation is good, so I went to Axis Bank, told them that there is problem is there. I'm investing in this company. Can you give me protection? The CDS spread. The CDS spread is the premium. The CDS spread is 1% per annum. 1% every year. Pay 1%. Should it be paid at beginning, at end? Depends on the terms of the agreement. Everything, because it's an OTC product. OTC means I will decide what should be the terms. Now, right, annual premium. All these are very simple. Annual premium is equal to notional amount into CDS spread. Notional amount into CDS spread. Notional amount into CDS spread. 10 lakh into how much the CDS spread? 1%. I have to pay 10,000 every year. Now, why are we paying this 10,000? Very simple logic, that I want a protection in case default happens. Company A has defaulted on the debt. It has defaulted on the debt, and bonds are now trading at 15% of face value. Trading at 15% means recovery will only be 15% now, because price has gone down to 15%. How much settlement would bank B give to the investor? Two options: physical or net. Net means 85% settlement. Physical means 100% money will be paid and 15% would be recovered later. Now, right, default, physical settlement, investor will give bonds. Investor will give bonds of company A to Axis Bank. Will give bonds of company A to Axis Bank. Bonds of company A to Axis Bank. Axis Bank will pay face value of bonds rupees 10 lakh. That's all. Story ends here. What will Axis Bank do? They may sell this and recover 1 lakh 50. I'll transfer my bonds to Axis Bank and they have to pay me 10 lakh for this. If I want to do those legal formality of transferring the bonds, all that you want to do, you do this. You don't want to do all those legal formality, then go for net settlement. Then go for net settlement or cash settlement. Net settlement. Compensation from Axis Bank is equal to 10 lakh into 1 minus 15%. 1 minus 15%. 15% is the recovery. 10 lakh into 1 minus 15%. 15% is the recovery. 8 lakh 50,000. A very good product. Only thing is, if people keep doing this without proper hedging from a bank point of view, not from our point of view, not, it doesn't really matter, but from a bank point of view, if they do like this, there could be trouble. Any doubts in this? Okay, sorry, fourth part. Okay, third part. Company A has not defaulted and the bonds have been redeemed in accordance with the debenture term. Investor A is now crying, saying that I paid premium for 5 years. I paid premium for 5 years. How much would be the settlement from Axis Bank to Investor A? No settlement, because default has not happened. Forget the premium. So write no settlement. No settlement. Forget the money paid. Forget the money paid, which is very logical, because you wanted protection. Protection is given. Now after that, if default has not happened, be happy about it. no compensation would be given. Then part D, another investor wants to buy protection, approached Axis Bank, and now Axis Bank is saying 2.5%. Axis Bank is now saying 2.5%. For me, it's 1%, it's over. For me, they will not change. 1% contract already entered. But after maybe a year or two, you went, and for you, they're saying 2.5%. What is the inference? Inference on credit quality. Now, what is credit quality? Is ability of the company to repay the debt. If Reliance Industries credit quality is good, low premium. If premiums start going up, it means Reliance is becoming weaker and weaker. So what is the inference on credit quality? Quality is deteriorating. Credit quality means ability to repay the debt of the company. The credit quality is having a deterioration because premium went up. Premium went up. Any increase in insurance premium indicates increase in risk. Indicates increase in risk, and increase in risk indicates increase in risk of default, which indicates bad credit quality. Bad credit quality. Clear? Any doubts on this now? Right? Increase in CDS spread is an indication of higher risk and hence weaker credit quality. Weaker credit quality or deterioration in credit quality, whatever name you want to give. Weaker credit quality. CDS spread going up is an scenario or is an explanation for deteriorating credit quality. For if I take a loan, CDS spread is going to be different. That is, somebody wants a protection against my loan. You take a loan, CDS spread is going to be different. Somebody else takes a loan. So we want protection. So if company A was taking a loan when it was good, 1% premium. Now suddenly it has become bad, and now 2.5% premium. Clear? Any doubts on this? Can you proceed? Practically, banks may even say that we are not giving insurance itself, because like Reliance, the other Reliance faction, I may not give any CDS protection itself because it is on the verge of default. If you are very sure about default, why do you want to give this protection? Clear? Any doubts on this? Okay. Index CDS. Now let's understand what is index CDS. Listen, index CDS is nothing but Nifty. Nifty has 50 companies. Sensex has 30 companies. So, like that, a CDS could be on an index of 50 companies, 100 companies, 200 companies, and in that, one of them defaulted, you pay compensation for that company. That does not default, you do not pay compensation. So, instead of taking protection on one company, I'm taking protection on 100 company. Let's understand. Gil Westmore is the fixed income portfolio manager for Allied Insurance. Westmore has bought protection using a 2-year CDS, 2-year CDS on CDS IG 125 constituent. 125 companies are there. 125 companies. Notional is rupees 200 crore. Notional is rupees 200 crore for how many companies? 125 company. Company X, an index constituent, defaults and trades at 25% of par. Compute the payoff and the notional principal of the CDS after the default. Notional principal of the CDS after the default. Once default happens, 125 companies will become 124. That is removed from the contract. Settlement done, closed. Now you have to pay premium only for 124 companies. So now write notional amount per company. Notional amount per company is equal to 200 crore by 125. 200 crore by 125. 200 by 125. What's the number? 1 point 1.6 crore. Now this company, one of that company has defaulted. I'll give compensation on that. I'll give compensation on 1.6 crore. And after the compensation is given, the notional principal from 200 will go down by 1.6. Will go down by 1.6. Clear? Any doubts on this? Compensation. 1.6 crore. Any recovery possible? 1 minus 25%. 1.2 crore. All these are simple example to explain the concept only. I have not got into valuation and other things which are extremely complex areas. Notional principal after default 200 minus 1.6. 1.6 is removed from the calculation. 1.6 is removed from the analysis. Now onwards pay premium only on 124 companies. Now onwards pay premium only for 124 companies are technically on 198 crores. Future premium will only be on 198 crores. I had a vehicle, I had 125 vehicles, was paying premium for 125. One of them got lost, that I got a compensation. Now I'll pay premium only on 124 vehicles. I'll pay premium only for 124 vehicles. Any doubts on this? Clear? Can you proceed? Rose Foundation entered into a 2-year CDS. This example I think is there in your ICISM. This was an example they gave. 2-year CDS on a notional amount of 10 lakh of 5-year bond issued by the Crescent Operation as a protection buyer. Swap specifies an annual premium of 55 basis point. 55 basis point means 1 basis point is 0.01 percentage. 55 basis point means 0.55 percentage and cash settlement. Assume that Crescent Corporation defaults at the end of first year. At the end of first year, when the bonds are trading at 60 paise on 1 rupee. Recovery is 60 paise, loss is 40 paise. Calculate the cash flow. What is the cash flow? First you have to pay premium and at the end of the year you will get compensation. Second year no premium and all. First year pay premium and get a compensation. Normally premium could be paid at the beginning of the contract and you will get your money at the end of the contract in case the default happens at the end of the year. Here the default happens at the end of the year. If it happens at the end of 6 months, get compensation at the end of 6 months. All right. Premium paid. Premium paid is equal to 10 lakh into 0.55%. 10 lakh into 0.55%. 10 lakh into 0.55%. How much? 5,500. Compensation received. Compensation received 10 lakh into 1 minus 60%. 60 paise recovery. 60 paise recovery in 1 rupee. 1 minus 60%. And question said very clearly cash settlement. Cash settlement, no delivery of bonds and going for a physical settlement. 10 lakh into 1 minus 60%. How much? The examples given are just to get little bit more clarity rather than keeping a theoretical discussion. Otherwise, questions may not come like this. I feel they may end up asking it in an MCQ form is my sense. Any doubts on this? Clear? Can you proceed? An investor buys 10 lakh 5-year protection and the CDS contract has a duration of 4 years. Company's credit spread means the CDS spread, our premium was 5% and same as now widened to 8%. Originally it was 5%, which itself is very high. Now it has gone up to what? 8%. Does the protection buyer benefit or lose from the change in credit spread? Estimate the CDS price change and profit of the investor. Now, what is profit of the investor is I wanted to speculate. What did I do? I entered a contract with ICICI Bank saying I'll pay 5% premium. Okay, 5% premium for how many years? 4 years. The duration is 4 years. I entered contract. Maybe another month or another 15 days, premium have now gone up in the market to 8%. Premium has now gone up in the market to 8%. So I have a contract at 5%. You wanted to enter into contract with the ICICI Bank, they quoted you 8%. They quoted you 8%. So what I do smartly is I come and explain you this, saying that I already got a contract at 5%. I will transfer it in your name. I'll transfer it in your name. What you need to do, pay 5% to ICICI and pay 3% to me. Pay 3% to me because you have to pay 8% to ICICI. Would you exactly pay 3? We may negotiate and may fix 2 points. All that is negotiation. But what is logic here is I entered a contract at 5% and this contract would allow me to pay 5% premium. Now what I am doing is I transfer this to someone else who has to pay how much? 8%. Who has to pay 8%. So when premiums go up, I became very happy. Why did I become happy? Because I am paying 5. Everyone else is paying 8. Everyone else is paying 8. So I technically save 3%. I technically save 3%. 3% per year is my profit. 3% per year is my profit because what others are going to pay? 8%. What am I going to pay? 5%. So one option is I transfer the contract, get 3% from you for every year. Other option is you pay 8%, I pay 5%, and I'm very happy every year because you are paying higher on the same company. I am paying lower on the same company. So does the investor benefit or lose? He is benefiting here. He is benefiting because 5 became 8. It can happen reverse also. 5 became 3. You all are paying 3%. I am paying 5%. So I'm unhappy about it. I am unhappy about it. That is a loss for me. To put it simply, if credit spread goes up, protection buyer will be very happy. Protection buyer will be very happy. Who will be unhappy? Protection seller. Protection seller will be unhappy. Any doubts on this? Increase in CDS spread indicates deterioration in credit quality. Profit for protection buyer. Profit for protection buyer. Notional amount into change in spread into the duration. Loss for protection buyer in case of decrease in spread. Loss for protection buyer in case of what? Decrease in spread. Increase, everyone is very happy because I am paying only 5%. Other guys are paying 8-9%. It can happen the reverse. I am paying 5 and others are going to pay 1-2%. That time I am really unhappy. I am unhappy about the movement. Clear? Able to understand the logic here? Let's write. Increase in CDS spread. CDS spread. Profit for protection buyer. Profit for protection buyer. Increase in CDS spread. Profit for protection buyer. Profit equal to 10 lakh into 3%, 4 years. Every year you will get this benefit. Every year there is a benefit. 10 lakh into 3% into 4 years. How much a profit? 1 lakh. Every year technically I save 30,000. Time value of money is ignored in the calculation. I can ideally also bring time value of money, but I think the solution or whatever, wherever I read in CFA, they were not bringing the time value of money part. But if I want, I can bring time value of money also. 10 lakh into 3% into 4 years saving. 4 years saving. This is the saving for me. If I want, if I'm a speculator, I'll transfer it to someone else and get 1 lakh 20 and let it is his headache after that. He has to pay 5%. Others were paying 8%. He has already paid me that extra 3%. And if this further widens, he may transfer it to someone else and make money, and then the cycle will keep going on. Any doubts on this? Clear? A company issues 1 year bond and same has a probability of default of 2%. expected recovery rate is 20%. How much would the CDS spread? Now listen, the premium depends on two factors. One is probability of default. Second factor is recovery rate. Let's assume 100 rupees is the issued bond. 100 rupees is the issued bond. If a loss happens, if a default happens, the recovery is how much? So 80 rupee will be the loss of the investor. 80 rupee will be the loss of the investor. I will tell you to pay 80 into 2% because only 2% chance of default is there. Only 2% chance of default is there. So your premium will be 80 rupees into 2%. To put it simply, it's probability of default into 1 minus recovery rate. I don't want to give a formula, but logic is very simple. 100 rupee bond, 80 rupee loss. Will loss happen to everyone? No. Loss, the probability of the loss is only 2%. The probability of the loss is only 2%. Now, right, CDS spread is equal to probability of default into 1 minus recovery rate. 1 minus recovery rate. 2 into 1 minus 20%. 2 into 1 minus 20%. And this is a very simple way of telling you how insurance premiums are calculated. Vehicle insurance, they will first calculate what is the probability of a vehicle loss. Along with that, into 1 minus the recovery rate computation. There are a lot of analysis, but this is a simple logic. Simple logic is very simple. Point is, in case there is a risk of 10% chance of a medical issue happening to a patient, premium accordingly will be 10% into what proportion of loss can happen, and accordingly I decide the premium amount. So here it is 1.6%. Any doubts on this? Clear? Can you proceed? Assume that company's hazard rate is a constant 8% per year or 2% per quarter. What is hazard rate? Is the probability of it defaulting. So hazard rate is 2%. Survival is 98%. An investor sells 5-year CDS protection on the company with the premium paid quarterly over the next 5 years. Over the next 5 years, I have to pay premium every quarter. You are required to compute what is the probability of survival, right? Probability of survival is equal to 1 minus probability of default. Probability of survival, 1 minus probability of default. Survival for first quarter. Probability of survival of first quarter is equal to 1 minus probability of default. 1 minus probability of default. 1 minus probability of default. 1 minus 2%. 1 minus 2%, 98%. Clear? What is the conditional probability of survival for the second quarter? Now, what is conditional probabilities? You have already survived in the first quarter. If you have already survived in the first quarter, if you want to survive in the second quarter, again 98% chance. Again 98% chance. You have already survived in the first quarter. You have already survived. I tossed a coin. First toss, heads has already come. In the second toss, what is the probability of heads? Again getting 50%. First toss already heads is done. Second toss, if you do, what is the probability? 50%. Second toss again you got head. Third toss again you wanted heads, 50%. Fourth toss again you want head, 50%. All the four you want heads, 50 into 50 into 50 into 50. So listen, what is the probability of survival through second quarter? And what is the conditional probability? Understand the difference. First quarter 98% chance of survival. Second quarter 98% chance of survival. 2 quarters together survival 98 into 98. 2 quarters together survival is 98 into 98. First quarter survival 98. First quarter you have already survived. What is the probability of surviving in the second quarter? Again 98. First quarter I don't know what happened. Together what is the probability? 98 into 98. So what is the probability of survival through the second quarter? Survival in first into survival in second. Survival in first into survival in second quarter. Clear? Able to understand the difference? I tossed a coin. I already got heads. What is the probability in the second toss? 50%. First toss heads has not come. What is the probability of getting two heads? 50 into 50. So surviving the first quarter 98%, second quarter 98, third quarter 98, fourth quarter 98, fifth quarter 98. Like this 20 quarters 98 into 98 into 98 is the survival. So ultimately for 20 quarters, if you see here, you need not do. Surviving in 20 quarters 0.98 power 20. Only 66% chance of this company surviving in the end. 34% chance of it defaulting in any of the quarters. 34% chance there is a default which can happen in the first quarter. Second, if it happens in the first quarter, only one premium paid and entire amount I have to pay. At least if it happens later, the company would have earned some premium income and in later they will give the compensation. It survives after all the quarters, no settlement. Clear? Any doubts in this? So very simple concept of CDS spread. I'll repeat again just to close this. There is a company A which is issuing bonds. It's not issuing shares. I should have put in the diagram issuing bonds. I issue these bonds. I'm issuing these bonds to the investor. You are happy about my company, but still you want some protection. So you go to bank B, take the protection. In case default happens, bank B will give you settlement. Default does not happen, bank B will not give you settlement. What your job is? Pay premium every year. Pay premium every year. This premium will be received by me every year. As an insurance company, I'll receive the premium and I'll give you settlement if default happens. No settlement if default does not happen. Settlement can be physical, can be net, can be physical and can be net. If there is an increase in premium, deterioration in credit quality. Increase in premium is deterioration in credit quality, and if credit quality deteriorates, indirectly you are happy because you've already taken protection. You've already taken protection, so you're indirectly happy about it because premiums have gone up, but you are paying the lower premium. So the difference is your saving or the profit. The difference is your saving or the profit. And amount of premium is equal to probability of default into 1 minus the recovery rate. Clear? Any doubts on this? Done. I'll take a break now itself.